Hello, and welcome to Credit Compass, your guide to navigating European credit markets. Volatility has certainly been the name of the game this year. While the growth outlook remains broadly constructive, markets are also grappling with uncertainty, particularly around the disruptive effects of AI. This week, we're looking at credit through a banking lens. We'll start with what bank surveys are telling us about the road ahead, and then turn to recent results from several large European banks. All right, let's dig in. First up is the International Association of Credit Portfolio Managers, or IACPM, which surveys credit managers across global banks, insurers, and asset managers. The latest results point to rising concern about credit conditions in the months ahead. Now, credit portfolio managers are conservative by nature, so these results always need to be interpreted in context. For example, the consensus expectation has been for higher defaults since 2021. What matters here is not the level, but the direction of change. And on that front, the most recent quarterly results have shifted more negative after a relatively positive third quarter, i.e., the least negative reading in over a year. Expectations for defaults in Europe have now worsened. Today, 53% of respondents expect an increase in corporate defaults, 40% expect no change, and just 7% expect defaults to decline. That translates into a net balance of minus 46.7, compared with minus 35.1 in September. Now, Europe sits slightly more negative than the global average of minus 43.8. By comparison, Australia and Asia are the most constructive regions, while North America is viewed as the most challenging. By sector, expectations for both commercial real estate and consumer credit have turned more negative. Commercial real estate, however, remains in a materially better position than a year ago, even if sentiment has softened recently. Consumer expectations are broadly unchanged from last year. Let's turn now to the European Central Bank's Bank Lending Survey, soliciting the views of senior loan officers and released on February 3rd. The results broadly align with the IACPM findings. European banks reported a net tightening of credit standards for firms, reversing the slight net easing or neutral views seen in the third quarter. The net percentage of banks tightening standards rose from minus 1% to plus 7% in the latest quarterly results. Where the ECB survey differs somewhat is on the consumer side. Banks reported a slight net easing of credit standards for households purchasing homes at minus 2%. That said, they did report a net tightening of 6% for consumer credit more broadly. Looking ahead to the first quarter, banks expect further modest tightening in credit standards for firms and mortgages. Concerns around consumer credit are expected to increase more meaningfully. On the demand side, firms reported a slight increase in borrowing demand in the fourth quarter, following a similar rise in the prior quarter. This was driven primarily by inventories and working capital needs. Demand for fixed investment was broadly neutral. More on that later. Digging deeper, non-performing loans played only a minor role in tightening decisions. Instead, risk perception and risk aversion were the more dominant factors. Risk officers expect these concerns to persist, with a view that risks continue to rise into 2026. The sectors drawing the most concern are construction, wholesale and retail trade, energy-intensive manufacturing, and commercial real estate, all of which saw tighter standards in the second half of the year. Auto manufacturing stands out as the sector with the largest net tightening. Looking ahead, expectations are for either further tightening or unchanged standards across most sectors. Demand is expected to rise in most areas, with the exception of automotive manufacturing, retail, and commercial real estate. One interesting addition to the survey was a new question on trade and shifting trade policies. Just under half of banks viewed their trade exposure as important and associated with tighter credit standards. Meanwhile, the majority, or 55%, said trade policy was not a material factor in their lending portfolio. Regionally, German and French banks reported the tightest standards for firms, while Spain and Italy were largely neutral. On the demand side, fixed investment declined in Spain, and France rose only marginally in Germany and was strongest in Italy. Despite the headlines around AI-driven capital spending, this is not yet clearly visible in bank lending data. That investment may instead be flowing directly through capital markets, as in the recent Oracle and Alphabet borrowing, or via private credit. This is slightly concerning given the expectations surrounding the role AI-driven capital expenditure is to have on the growth picture for Europe going forward. Banks are also continuing to strengthen their balance sheets as regulatory and supervisory pressures encourage higher capital and liquidity buffers. The deregulatory push seen in the US does not appear to be spilling over into Europe, at least not yet. So, what do the actual recent bank results tell us? Here, broadly speaking, the message has been reassuring. Credit performance remains relatively benign, and positioning levels have returned to more normalized historical ranges. Provisions are not unusually low, but they are no longer rising. Where concerns do exist, they tend to be idiosyncratic. Across BNP Paribas, Société Générale, Crédit Agricole, Santander, Intesa Sanpaolo, Lloyds, and Barclays, management team's 2026 outlook is broadly a soft landing / normalized credit message. They expect asset quality to remain resilient, with the cost of risk generally guided within established ranges, while the big earnings swing factor shifts to falling rate pressure on net interest and intensifying deposit or mortgage competition, most explicitly at Lloyd's, prompting renewed emphasis on cost discipline, fee mix, and capital returns. On the risk side, banks continue to flag pockets rather than system-wide stress, particularly commercial real estate and leveraged finance, highlighted in particular by BNP in their results. And Intesa is positioning its plan around ongoing de-risking and strong buffers, all of which collectively reads as supportive for European banks unless growth or property conditions deteriorate materially. UK banks continue to flag some pressure in consumer credit as borrowers continue to roll off low-rate mortgages, but even so, impairments remain broadly in line with expectations and long-term norms. Across continental Europe, banks generally describe a soft landing in the credit cycle, particularly in Germany and France. Commercial real estate, especially in Germany, remains under scrutiny, but there is no sense of late-cycle panic. So, let's bring all this together. Even as the growth outlook improves and the potential for upside surprises remains, credit managers are paid to look ahead, and looking toward 2026, concerns are clearly rising. While equity markets continue to price in an AI-driven growth story, credit portfolio managers are increasingly focused on the risk of higher defaults. Banks are responding by tightening credit standards modestly. That said, these concerns are not yet showing up in the hard data. In many ways, this reflects the classic cockroach problem in credit. Risk managers are always worried there's another one out there. Their job is to stay vigilant, even when fundamentals look sound. Based on reported firm results, European banks remain in a strong position. Capital levels are robust, asset quality is good, non-performing loans are low, and banks do not expect a material deterioration. What they do expect is a continuation of these historically normal default levels and an ongoing return to a more normalized banking environment. So what does that mean for markets? Well, here, the IACPM survey offers a useful signal. In Europe, 38% of respondents expect the iTraxx Europe Index to widen, while 59% expect spreads to remain unchanged. For the iTraxx Europe crossover, 44% expect widening and 52% expect no change. Very few expect tightening, just 3% for the iTraxx Europe and 4% for crossover. That takeaway is consistent with the message we've been delivering. Be prepared for volatility. Credit fundamentals remain broadly healthy and the macro backdrop is improving, but valuations suggest that risks to spreads are skewed to the downside. A sensible approach may be to move up in quality when markets are complacent and selectively add high-yield exposure during periods of spread widening, because there will likely be more volatility going forward. That's all for this edition of the Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It really helps others to discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.